Hey everybody, welcome to Trading Capital's daily analysis video. I'm your head market analyst. All right, so today lots of action to discuss. First off, I want to congratulate you guys and myself for pulling off 16 trades. We closed 16 trades, 14 winning swing trades today in our pocket. Huge profits. This is why we prepare and look at charts and ready to execute at any moment because the volatility has been wildly insane. Just looking at the S&P 500 here, you can clearly see a dip down, went negative. This is when I started covering and issuing alert after alert after alert to cover so many trades. I'm not even going to go through some of the trades, but just the likes of UVXY in one session over 18%. And then we had many other double-digit winners. I did close a couple of losers that have been in our portfolio for a little longer than I anticipated that went against us, obviously with the likes of JPM, which turned out to be a great cover because it is off of the lows. But looking at the S&P 500, although we still covered many shorts, we did accumulate some longs today, which I'll touch base on in the video. But too many people now are on the bearish side too quickly. And this is the thing about trading and timing, market timing. They say you can't pick bottoms and tops, but you can certainly pick the near bottom and the near top. And that's what we try to do here. Now, my overall thesis, do we have more downside? Yes, I think we do. However, I think we're going to get a little bit of a push tomorrow or maybe sometime on Friday just to cause a lot of max pain. My interpretation of the market, I always try to think of it as like, okay, where would the max pain be for all of the market participants? Where do market makers have to push the market to basically create that max pain, max loss? And that's how the markets work. And why I covered so many shorts is because we had a significant decline. You've had banks getting demolished again. The Russell was down substantially. And overall, I saw some accumulation patterns going on intraday that I do think is going to provide a little bit of a boost. And why I think we're going to get a boost is because so many people now with the bank blowups, we had Credit Suisse announce, or the Saudis announced that they're stopping their funding to Credit Suisse or any future funding. So that took about a 30% dive at the end of the market. But again, I think Credit Suisse is too important of a bank to not be bailed out. I think the Europe will dilute their pound substantially, and I'll touch base on the currency market and what I think is going on. But overall, I think the S&P can get a little bit of a bid. There is a gap fill at 391, and I think we could retrace actually round to this area. And there's even the potential that we could retrace back to, oh, that's not the right level. Let me just draw that in correctly. I think we could get a retrace basically in and around this proximity, trying to maybe recapture this neckline. It would suck a lot of the bears out of the market. It would pile them in on the long side before I think they take us back down. But ultimately, the amount of volume today has been insane. The S&P did finish off of the lows quite nicely, and we insulated our portfolio by buying the SPX L, which is a double leverage of the ETF. And one of the reasons why I warned you members of this intraday potential pattern where I said we covered a whole bunch of shorts in and around this low vicinity, and then we said protect our portfolio with an SPXL hedge. Take a look at this trend line. You know, basically this was your pattern. You had this little bit of a bullish inverse head and shoulders that actually broke out to the upside over here. We caught this whole wide range red bar move. We actually played the double S&P intraday. This was the alert down here. I ended up selling pretty much right where I told you members take profits and protect it. And basically, I'm back in it again myself because we got a picture perfect retrace almost on this candle. Now, why I think there's more upside, because this pattern actually has technically some more upside. This little calculation should take you to this gap fill. That's why I think the markets are going to head higher tomorrow initially, and then we start to see a bigger roll off. But again, it's not a guarantee because there's a whole host of economic data that we will touch base on. And a couple interesting points. There's a sector specifically I want to touch base on, which was the XLI, before I dive into all the other ETFs. Take a look at this volume on the industrials. Industrials took a massive kicking today. The industrial sector fell 2.46%, but did rally substantially off of the lows. And why did the XLI fall this sharply? Well, we had PPI come in that showed we're potentially starting the deflationary process with the producer price index falling greatly. It actually, market expectations were expecting a consensus of 0.3% month over month increase. We actually got a decrease. And then the year over year data came in, consensus was 5.2%, and it came in at 4.4%. So Typically, PPI does lead CPI by a month, so it maybe is showing that next month we're going to potentially get a lower CPI than the market is forecasting. And that makes sense because these bank blowups that are occurring should be factoring into the next CPI. And then there's another important economic data point that came out this morning, which was the New York Empire State Manufacturing Index. Market consensus was for a decline of -8. We got a whole whopping -24.6 decline in the New York Empire Manufacturing Index. That is a whopping mispricing of the market, which is why industrials fell sharply, which is why Caterpillar, those names fell sharply. And ultimately, I do think there's a lot of oversold names in this market, which is why I think we can get a technical bounce. If you take a look at the Qs, a lot of people are looking at this QQQ as a bullish pattern that's on the verge of breaking out. They could potentially be right, which is, I think we're going to get a little bit of a push up to the upper end of this range before this becomes a great fade. So tomorrow, if we get a pop in the markets at all, be ready. Be ready to fade the market because I think we're going to be on borrowed time. NASDAQ tech has really been insulating this market decline. And once tech starts to roll over, and it will, it's certainly going to bring this market down heavy and heavy very quickly. And remember, tech still has the most weighting in the overall market. And once that starts to wane, it's certainly going to come down. Now, a lot of people are hopping on the tech like this is a bull flag. You've seen tremendous strength in Apple, Microsoft, a lot of the mega caps, Nvidia. But I'm not in this camp. Again, the markets are liking the fact that the yields are collapsing sharply. If you look at the 2-year yield again, boom, nasty, nasty bearish close outside of your wedge pattern. This is now on watch for a technical breakdown on the daily chart. You get a technical breakdown, then basically what this is telling us is that we can look for a bearish pattern on yields to accumulate bonds for the next leg down in yields. And realistically, tech is taking this as a positive right now because cost of capital is cheapening by the day, exceptionally much cheaper. I mean, we've fallen over 110 basis points in literally 4 days. The volatility in the yield market is one for the ages. It is just fascinating to watch, and this is the reason we are trading. This is the reason you cannot be an investor, because realistically the cost of capital is changing so fast that even if you have a fundamental view of a company, it's really not that important when yields and cost of capital and the economic conditions are dwindling so fast. So this is why we trade in this market, and it's certainly not going to change for a decent amount of time, and we're going to continue trading around this volatility. Now the fact that yields are collapsing, one thing that we have to keep in mind is that the Fed fund rate is up here at 4.5%, this green line. So there's a huge discrepancy between what the Fed fund rate is and what the 2-year yield is saying. So basically now the market is pricing in a Fed cut. Not just a quarter basis point, but more than 50 basis point cut in the Fed fund rate. Now, this is what's interesting. We're in this Federal Reserve blackout period. They only really speak, I think it's the 26th or sometime near the end of the month, we get the next FOMC rate decision. I know the ECB has their rate hike tomorrow, but we might be in a situation where policymakers over tighten, because right now the market is pricing in one thing, and what happens if the Fed pauses, or what happens if the Fed and Powell just bites his tongue and tries to save face and make it look like he's certainly aggressive and actually raises rates by 25 bips? Because remember, that's the last consensus that the Powell has said, was that they're going to raise by 25. Certainly the bond market is pricing in something else, but again, what if they do raise by a quarter basis point? We could see more blowups. We're certainly going to see a massive decline. But up until that, the cost of capital is getting cheaper. And right now there is a huge discrepancy in the Fed fund rate and the overall 2-year yield, which is why I think the markets can continue to bounce, and which is why I think we've seen so much strength in tech. As long as there's that discrepancy between the Fed fund rate and the 2-year yield, I think markets can continue to bounce. So we're certainly going to have to pay attention to that aspect. Now, tomorrow morning at 8:30, we have building permits. That's going to be crucial for housing, crucial for any insights. Real estate is still looking very, very vulnerable. I mean, you have this bearish inside bar still occurring, even though you've had a massive bounce off of the lows. We'll certainly have to pay attention to that. ITB is showing signs of weakening, although it did save itself from this key trend line today, but we added near the highs to our short. We obviously are short Lennar, which had a nice reversal on earnings, or basically break even on that. But these building permits could also spike yields if it comes in hotter than expected. But we'll just have, and they could also lower yields. And I think we're at the point now where if yields spike, it's bad for the market. If yields drop, it's also bad for the market over the medium to long term. Short term, sure, stocks can rally on softer yields, but eventually the markets are going to have that snap in phase like, oh my goodness, we're in a recession, things are looking bleak, and that's when you get typically a earnings compression. And the next earnings period is going to be wild, because will we start to see these rate hikes come into these companies' earnings effects? We have basically tomorrow marks the 1 year anniversary of the first Federal Reserve rate hike. Just take that into account. It typically takes roughly 8 to 12 months for the first rate hike to hit. And now I think we're actually seeing these rate hikes hit the market. And again, we haven't really seen the 75 bits, the 50 bips hikes that the Fed did hit the market as of yet. Not only do we have the building permits, we have the Philadelphia Fed manufacturing. So that is also going to affect the industrials. That could also be mispriced by the market. And if that comes in lower, the manufacturing, Philadelphia, that's one of the most economic important leading indicators that I specifically watch for. And I'm certainly going to be paying attention to that aspect. And basically, we also have initial job loss claims tomorrow. So three massive, massive data points that could really mess with the markets. And then we also have the ECB. They raising their rates at 9:15. So we'll have to certainly pay attention to what is transpiring, lots of market action. And then I think one of the aspects as to why the Fed manufacturing is falling off a cliff and is likely to do so, take a look at oil. Oil finally broke down this beautiful pivot. It took out this major pivot, broke this wedge pattern. You got your confirmed breakdown. And now oil, I have a new price target on oil. I'm not going to give it out, but it's lower. There will be a phenomenal buying opportunity. This is going to be, once it hits the level that I have, it's going to be not a trade. It's going to be an investment, a long-term investment. So anybody who's an oil bull, get ready, because I do have a phenomenal level that we will buy. It's much, much lower. Oil did hit my near-term target. We called for $66 in the last month. We've been calling for $66. Look exactly where you hit. $66, just a pierce of that technical level. So we have been spot on. We actually day traded this for a nice profit. We actually sent the alert out. We played the UCO. We did it on our live day trading channel. We're putting in the comments. But look at that bounce. And since we're on the energy topic, one thing, we're back in natural gas. UNG, baby. First off, I want to touch base on the actual natural gas chart, because UNG is just the derivative play. We've been patient. I've gotten a lot of messages regarding the fact, oh my God, we're going to miss the UNG trade. We're going to miss the natural gas trade. Like, what are you doing? That 7% pop, we missed it, we missed it, we missed it. So look what I'm watching here. Natural gas basically retraced all the way back down to the same trend line again. And we got in. And one of the important reasons I got in at this level is because it actually fulfilled my intraday downside target. And we bought the UNG. Why? Look at the UNG chart. Major trend line, pivot to pivot to pivot. You got a beautiful retrace, and you made a new lower low after that initial gap up. And basically now I think the initial low in nat gas is in. If it isn't, I will accumulate more. And if it goes lower, I will accumulate more, because this type of pattern that is now forming on UNG and natural gas is primed and ready to look higher. I even day traded Boyle off of that level. You can see my green lines over here. And I'm still holding my Boyle overnight as a day trade. Because why? I think natural gas is going to be explosive to the upside. We got a 5-0. Let me just flip back to the UNG chart. We got a 810 close. It's up a little bit in the after hours. So I think we're going to see more short squeezing. I think this pattern is looking very healthy. Remember, it is options expiration, so there's roughly 3 to 4 trillion expiring on Friday, so they can push this down, they can push it up. They're going to find this max pain. The volatility is not done yet, but ultimately, these are the levels to take shots. We have been so patient after selling pretty much at the near-term high over here. We've waited 1, 2, 3, 4, 5, 6, 7, 8 trading sessions. Now we've shaken out a lot of weak hands, and I think we're poised to continue to move higher. But honestly, I wouldn't mind it going lower, because I'll just accumulate more. But nonetheless, we have beautiful exposure. What else did we buy today? Look at this rig chart. Boom. Rig. We executed the buy order at 550. Everybody should have participated in this. This is a powerhouse stock. Could it go lower on a falling demand and weakening economy? It could, but ultimately these are the levels to take advantage of. And I do think that we can even see an explosive move back up to 630, and I would look to exit the trade at that point in time. Let's touch base on gold because gold was a powerhouse today, closing up on the session at around 1918. It did finish up on the session just slightly, and it is poised to pretty much try to continue higher. But there's a couple things I want to touch base on gold as to why I think we're approaching mega resistance, and I think it's going to fall soon. Looking at the DXY was positive today, recapturing its bullish trend, and this is primed price action, typically of market makers trying to make people think the bullish dollar is losing. The fact that yields are collapsing, people are selling their dollar, getting out, not us. We are holding strong because the technicals told us to hold strong, and we're not listening to all of the news that, oh, the dollar's done, the yields are falling, The ultimate grand slam plan that I think is coming to fruition now is the Fed has been raising rates. The Fed blew up the fragile banks here in the States. And now what is coming to fruition, we're seeing blow-ups outside of North America. I think that is the next stage of this market cycle. We're seeing Credit Suisse. I think we're going to see something in China. I think we're going to see something in Japan. I think we're going to see blow-ups on every single continent, but the blow-ups are going to be worse than the ones here in North America. I think the blow-ups outside North America, specifically in Europe and Japan, are going to be horrendous. And I think that's what the Fed's ultimate endgame is. They know they can backstop their own banks. Realistically, the Fed is the only one that can backstop the whole world, basically, the financial system. But I think the Fed is going to make other countries dependent on the US dollar once again. It's a financial war that is coming to fruition. And if you think about it, why is the dollar up when yields are falling? The Fed doesn't even have to tighten at this point. If other banks outside the States are blowing up, that is investors rushing out of Europe, coming into the dollar, rushing out of Africa, coming into the dollar, rushing out of Asia, coming into the dollar. So this is why I think gold could fall, because the dollar could push up if we see more explosive movements happening outside of North America. And just be ready. There's certainly going to be a lot of banks that I think continue to fruition. And look at this rally from Credit Suisse off of the lows. A massive rally. I mean, it was still down substantially, but a powerful, powerful rally that you have to respect at this point in time. All right, now let's touch base on Bitcoin, or let's touch base on the GLD chart quickly and why I think we're going to hit some near-term downside. Basically, look at the GLD, pivot to high in 2022, major pivot to major pivot. Could you pierce through this on some extra fear and fill this gap? You could. You could also hit this original trend line, but I think gold is getting very, very toppy here. Believe it or not, my call, it's very against the overall sentiment of what the market is expecting and what the likely scenario is, but everybody is getting so bullish on gold, and I can see the case why. But based off of some cycle analysis, long-term cycle analysis, I'm going to tell you right here, I think gold could hit 1600 again or even 1500. That is my case. It's not what you're going to hear on mainstream. It's not what you're going to hear on these gold bug sites. It's not what you're going to hear in many places. Many places you're going to hear 2300, 25, 27, 3000. But I think I love gold. I'm an accumulator specifically of the physical. I do believe in it. I will continue to accumulate, but as a trading investment, I think gold is going to have one final capitulation, and it's not going to be because gold is a poor asset or it's not outshining anything or its fundamentals change. It's simply going to be because of margin call and banks blowing up. I think we're going to see some specific banks blow up that hold gold, that have to force liquidate gold positions. I think we're going to have to see forced liquidations in the stock market. It's not going to be because people want to get rid of their gold. It's going to have to be because people have to get rid of their gold. That's just my call. I might be completely wrong, but don't say you didn't hear it first from us. 1600 to 1500 based off of some cycle work. I think gold is going to go down. Now, the one thing I'm going to quickly show you on the chart, if we take a look at gold, okay, this is a 6-month, and let me just erase these levels here just so we can clear it up, okay? And I've done a lot of work on the price action of gold, going through historic price patterns and cycles and time. Gold. Let me just turn on some volume here. I think we will get it. The volume won't be showing on this chart. Gold, look at this is 6-month candles. Look at this 6-monthly reversal candle. You're not going to get through that on just 2 additional 6-month consolidation candles. Yes, you have a hammer candle to the upside, but when we look at the GLD, that 6-month candle, look at this volume you're trading up against. 1.36 billion shares in the GLD. What have you traded on this candle? Minuscule amounts. What have you traded on this candle? Minuscule amounts. Obviously, there's still 3 months left, but this hammer reversal is something that's going to take time to get through. And honestly, when you have a 6-month hammer reversal on obscene amounts of volume, it's going to take more than 2 additional 6-month candles to get through. And I just think the gold trade is getting very crowded. And one thing I know about crowded trades is they often end poorly. Realistically, on that note, I'm going to call this video to an end, but I'll touch base on Bitcoin really quickly here. Bitcoin is still putting this beautiful daily reversal. It is getting some buy pressure off the lows, but I still think Bitcoin's heading lower. I mean, once the QQQs in tech really starts to decline, which I think is on the horizon, maybe a little bit more of a push up, Bitcoin should see a massive fall from grace. One of the charts I like to look at for the total crypto, it's kind of like the S&P 500 for the crypto industry, is the total crypto market cap. It's on TradingView. It's a beautiful chart. And if you look at this long-term picture, all we've been doing on the total crypto market cap, right now it's at above 1 trillion. We've just been chopping in this range. You hit your high pivot, you hit your low pivot, you've hit your high pivot now once over here, twice again and reversed. And then the big level I'm watching is this downsloping trend line, major pivot to your major pivot. You almost had a technical breakout but reversed. And basically now you're looking to close back inside of that trend line on obscene amounts of volume. Look at this volume. The fact that Bitcoin can't be breaking out of this initial consolidation pattern on this amount of volume in the last few sessions tells me one thing. Big players are distributing into the little players. Don't be fooled by this price action. We'll certainly have to watch it carefully because I do think it's going to be a leading indicator for when technology starts to top out. And being the fact that we're already getting massive distribution signals at key resistance levels is certainly something I'm paying attention to. All right, on that note, congratulations on the profit. We made over another $14,000 today with those trades. We crushed it in the live day trading room. We basically killed our Coinbase short for a lovely gain. That thing had a 16% swing, but nonetheless, it was a wild price action session and we crushed it on the swings. We crushed it on the days. It's something truly to be proud of. I want to thank you all for being members. Please try to share this channel, comment on our videos. Obviously, these videos are exclusive behind the scenes, but all of the public videos, please share them on your timeline. If anybody's looking for educational content, all we're trying to do here is beat the market, learn from the market, and try to outpace Wall Street. On that note, I thank you all for being members, and we'll see you on the charts tomorrow.